Hello and welcome to the Law Eagles podcast. Today we have Brian Jenkins on. He is with Commercial Asset Advisors, CAA. He is one of the top commercial brokers here in San Diego. He did 190 transactions last year. Is that right, Brian?
Yeah.
That's amazing. I'm putting up Brian's information on the screen so you can see his information. This is the way to contact him. The LinkedIn information is commercial-asset-advisors-CAA. That's for LinkedIn. And on Facebook, you can find him at CAA CRESD. And the information is there on the screen for you. Brian, thanks for being on the show today. How are you doing?
Doing great. Thanks for having me on, Eric.
Yeah, absolutely. Thank you for being on. I really appreciate it. So today I wanted to talk to you. There's several things we wanted to go over. I know that some of this is considered investment, these are investment questions. So I want to make sure you give the audience an opportunity to know your disclaimer in regards to that.
Yeah, so the disclosure's out of the way first. My license number is there in the show notes, and no recommendations or representations are being made. So consult with competent advisors and tax professionals and attorneys before you make any investment decisions.
Gotcha. And that's the actual disclaimer right here. And this is an email that Brian sent me. And this is one of the reasons why I wanted to bring Brian on the show. I saw this email and this was phenomenal. He's talking about the arguments, and these are the bear and bull arguments for the commercial space. So he talks about industrial, retail, office space, several different sectors where he goes into this information. And it's really good information. And that's why I wanted to bring him on the show today. It was to go over those questions. Today, we wanted to focus on the bull market, right? Is that right, Brian?
Yeah, I think we'll love to do a follow-up episode on the bear case, but I think there's some reasons for optimism right now. A lot of people have talked about a V recovery or a U recovery or a W recovery. And I think San Diego's in a unique position nationally that I think we should be honest about what the upsides of this market are. And I think each product type is going to be have a slightly different story. As with anything, when things like this happen, everybody's got to adapt. Things have got to change. But I think there's a good case to be made that these won't be quite as painful as maybe a lot of people expect, and might be a lot shorter lived than a lot of people expect. So
definitely
love to go into each of these kind of with maybe we'll talk about some stuff on a macro level, and then kind of go into each product type.
Definitely. And there's, it's an opportunity for some arbitrage too, These markets where things are changing are good opportunities to get into things potentially on the cheap, potentially in a good position where other people aren't thinking about it. A couple things that we had talked about that I thought were really good topics and really good things to hit on before we get into those market sectors are, one, I want to know more about yields. Like, I want to understand better about yields and cap rates. And even with lower cash flow, how those are affecting values in real estate, because you had hit on that a little bit. So if you can go over that a little bit more, that would be awesome. If you could go into yield curves as well and just kind of explain how that affects the markets, and then also risk-adjusted investments and returns.
Yeah. So I think to start off, obviously none of us have a crystal ball here, but most of the stuff we're going to be talking about is from a real estate investor's perspective, right? So we're going to be talking a little bit today about office and retail and restaurants and hotels and things like that. This is going to be a slightly different conversation. There will be things that are correlated, obviously, with the actual operators of those facilities. And they're obviously an integral part of it. Those are the people that pay the rents. Those are the landlord's clients, if you will, are those tenants. But we are talking about today is everything from the landlord's perspective and buyers and sellers of investment real estate. So I think the first thing that's really important to understand is that when most people are talking about a value, they're talking about buying a building or buying an investment property. And when you're buying one, you're actually buying two things in most cases. You're buying the actual building that everybody knows. We talk about cap rates and how to value those, but you're also buying the loan to acquire that property.
And this is a discussion, you're talking about yield here, right?
Yeah. And so when interest rates go down, cap rates typically follow them. And the spread between those is your yield. That's the money that everybody's talking about making. Your cash on cash return would be another way to phrase it. And so it's important to see that, like, when you're when we're talking about cap rate, even if rents go down. So in an example, if you have an apartment building that your net income for the year is $100,000 and rents go down in a COVID environment, so let's say they go down to 80,000, they go down by 20%. But simultaneously, because interest rates dropped and investment activity is still strong, if cap rates go from 4% to 3%, the value of that property, even though your cash flow went down, goes up by almost 30%.
Wow.
So and this is because you're talking about an intersection of two different assets, both the loan that you're using to acquire the property and the property.
Because when you look at cap rate's the value of a property. It tells you the value, right?
Yeah, it's one way to look at it, absolutely, which is the primary investment property. Yeah.
Okay. So when you're looking at cap rate and you're looking at investment properties, cash flow is just one aspect of that. I think that's what you're explaining. So cool. So even if you're in an environment where you may have reduced cash flows, reduced rents, you still have prices going up, possibly.
Yeah, exactly. And that's, I think another way to phrase it is that cap rates are relative. They're a reflection of risk. So if people are perceiving the risk of the property going up, then cap rates have to go up to accommodate for that. But if at the same time interest rates come down, then those will track with it too. So,
gotcha.
Which I think is a good segue into the risk-adjusted returns, right?
Okay.
Because one of the things we talked about a little bit before here was, the 10-year Treasury yields. And if there was one metric that your viewers might want to sort of keep an eye on to get a feel for the volatility of the market, I think that's a pretty good one. It's a blunt instrument. It's not perfect, but it's a pretty good one to track.
And that's the yield. When you're talking about that, that's the yield curve inversion you were saying earlier?
It's a piece of it. And we'll get to that next. But the 10-year Treasury yield today is, it's about, we're recording this on June 4th, 2020, by the way. The yield today is 0.81%. So it's 81 basis points. Okay.
Big money.
So that's almost nothing. So if you're an investor that has money to invest, it's like, are you going to buy a 10-year Treasury at 80 basis points? Or are you going to get an apartment portfolio, even if it's a 3% cap, that has appreciation as rents grow and long-term, depreciation because it's a pretty tax favorable asset class? You got to measure that risk. And the 10-year Treasury has the full faith and credit of the United States government behind it. Apartments don't, but it's the risk versus reward. And I guess on the other end of that spectrum, it could be the penny stock your Uncle Ned tells you is the next Amazon or Facebook. That's super high risk and maybe it has a high return, but it's a risk-adjusted return. And so I think in an environment like this, real estate becomes a very attractive asset class. And that's why I think there's a real good case to be made for a bull market here, which is maybe a little bit counterintuitive.
Yeah, it absolutely is counterintuitive. Another part of that is how much those interest rates are being bolstered by government activity. Is there any kind of government activities right now that are changing the dynamics in this space?
Huge. And we're still going to have to see how this all comes out, because your average escrow, right, is 30 to 90 days on an investment property like this. So, 90 days ago, in our news cycle today, 90 days is an eternity, right? But so we still haven't seen really true post-COVID deals being done. So we're very much on the early sides of this. Real estate is an illiquid investment, so it's not going to react as quickly to market volatility, both early or late, say stock markets, which, for stocks, you always have that monkey on your shoulder saying you buy, sell, and you can do it instantaneously on your phone, even, in a matter of seconds. Real estate is significantly delayed. You hire an agent, you get it on the market, you negotiate offers, you get it into escrow. So it's like, I don't think we're going to see true post-COVID deals. The earliest ones will start closing in the next month or so. And again, today's June 4th. So
yeah. And a lot of real estate's done through 1031 exchanges, right?
Correct, which got a delay.
Huge delay, isn't it?
Through July 1st. So, there's a lot of stuff going on. So, the 1031 exchange delay is going to play an impact in terms of federal actions that you've talked about that have impacted this. And then, we'd be remiss not to mention all the stimulus that's happened, right?
Yeah.
So nearly $3 trillion of stimulus so far from the federal government that's been injected into the economy. You and I were joking before the recording here that, a trillion, we used to like stutter saying that word, a trillion.
Right.
It's, today it just rolls off the tongue. It's just like, oh, another $3 trillion.
Oh, yeah.
But it's
no big deal.
It's just an unfathomable amount of money. And I mean, to put it in context, $3 trillion, depending on what metrics you look at, is about equivalent to India's GDP for the entire, for an entire year.
Wow.
That's England's GDP. Little countries like that. France's GDP for the entire year. So I mean, that amount of stimulus is just, it's truly unparalleled. There's no place in history to look at that kind of amount of money.
Wow.
Even in the Great Recession, I don't have the exact figure in front of you, but it was like 800 or 900 billion, which everybody was like gobsmacked by just about how much money that was. And we just did many multiples of that.
And not only that, but so they increased the debt, they printed more money. But my understanding too is the Fed, in addition to that, is doing essentially quantitative easing as well. They're buying, and they're doing it on the corporate side.
100%. Yeah, I'm just talking about direct cash injection, which is just an adrenaline shot, and a massive one at that. And that nearly $3 trillion is just federal, right? And I was trying to dig this up a little bit before the show and was unable to really find it, but we'd be remiss also not to mention the amount of state funds that have gone into that, because the United States government is not one entity. It's that plus the 50 states plus all the hundreds of counties across the country that have also done their own micro stimulus programs. Every chamber of commerce I know has done their own micro stimulus program. I mean, the amount of money that's been injected in the economy would be almost impossible to calculate, but it's surely massive.
Wow.
I mean, every state has virtually emptied out their unemployment funds, which were massive tranches of money that were directly injected into the economy. And we're going to talk about this a lot in the apartment and retail sectors, because there's a recycling of that currency that I think everybody needs to understand.
So you think there's some inflationary tailwinds coming beyond the market?
Could be. I mean, and inflation's a weird thing, right? Because inflation it's not universal. I mean, inflation certainly hasn't affected flat screen TVs.
Right.
Flat screen TV you bought 10 years ago was 3 times more expensive, and if it was half as good, that would have been a miracle. So it's going to come across, and I think real estate is a place where you're going to see some of that push. Which is a piece of that thing. Is it going to come up in big screen TVs? I don't think so. Is it going to come up in cell phones? I don't think so. Technology is going to have deflationary pressures on those technologies, whereas real estate, I don't know if you've heard, they're not making much more of it. With the exception of a little area off Hawaii that got a little bit more land made lately. But
did they really? There's land being built in Hawaii?
Oh, that was a volcano joke. There was the volcano spit out some lava and made some more land.
Gotcha. Okay, that makes sense. Very cool.
But I thought maybe we'd start with apartments as a good product type, if that's a good place to start.
Yeah, absolutely. Let's get over to that. Let's take a look at it. Give me 1 second. Let me get this cleaned up real fast. So you want to look at apartments, multifamily bull?
Yeah, multifamily bull is a good one. And I think I kept it relatively short there, but apartments I think are a good place to start. It's kind of the darling of private real estate investors everywhere. It's known for its economic resilience. Pre-corona cap rates were 4 to 5%, depending on which area you're looking at. But so far we've seen high 90%. I mean, I'm talking 97, 98, 99, 100% collection rates of rent for April and May. As of June 4th, there's not good data on what June rents will be, but that's a terrific thing that I don't think a lot of people expected.
Those numbers are way better than I would have ever thought of, hearing all the stuff I've heard.
So in talking to multiple property managers across San Diego that manage thousands of units, I can say that's almost universal. Very, very high 90% payment rates. A lot of them are still having 100% pay rates. Maybe so when we were talking earlier about yields and cap rates and having lower cash flow, you're not even seeing a lower cash flow. Not yet. No.
Wow.
No.
And so there's an arbitrage here. So basically you have a potential where you may have people, commercial people that are putting their properties on the market anticipating a downturn, but they're wrong. And you might be able to get a nice little 5-10% swing in price.
Very well could be. And I mean, I, like we said in the beginning, no crystal balls here, but I think there's a very good case for a bull market. We'll do the bear case for that on a second episode here.
Cool.
But I mean, let's dive into that a little deeper, right? So many renters right now have more money in their pockets than they did before. Unemployment, even though there's a lot of unemployed with the stimulus payments that have gone directly into their pockets, many renters, particularly in the lower income brackets, are making more than they were when they were employed. I'm hearing this from multiple business owners that are seeing that they're having a hard time even bringing their employees back because their employees are going, wait, for the next 6 months, I'm making more money by staying at home with my kids than I would be by working 8 hours a day. So why would I go back to work? And simultaneous to that, a lot of these folks are their spending has gone down. They're not paying for childcare. They're not, they're going out less. They're, maybe got some help on an apartment or a car payment, or their credit card debt went down, or all these kind of things. I mean, so from their standpoint, I mean, it's been a complete flip. They're making more money and they're less, and savings is way up. We're starting to see some of the data on that, and it's really impressive. So I'm not seeing on the income side much degradation at all. Certainly not yet. And there's a good case that doesn't happen nearly as anybody's expecting. So I don't think anybody really put all that together beforehand. I certainly didn't. And I think that's been a real glimmer of hope for values. And then on the cap rate side, like we talked about earlier, that's on top of the fact that now interest rates have dropped significantly. So I've seen a number of my clients refinance their properties in this environment and cut their interest rates substantially, which really puts more money in their pockets. And either they're doing a cash out refi, or they're just refinancing their existing debt and significantly increasing their cash on cash return. So, gotcha. And if they were to sell it, I mean, I think you're going to see the same thing. So we talked about as interest rates go down, cap rates can go down too. So if their rents don't go down and cap rates go down, I mean, we're talking 30, 40, 50% differences in value potentially. So wow. There's a strong bull case to be made for apartments. Apartments have always been known for economic resilience, and this environment has been no different. Especially in San Diego, right? San Diego's got a real strong tenant. We do, and I think you're also seeing there was a steep rise in home prices that we're seeing now coming out of this, which makes sense, right? I mean, if anybody has been quarantining in high-rise apartments, or if they got kids and they're in high-rise condos and stuff like that, that's a harder thing to do, and it makes the dream of single-family home ownership even more desirable, which is putting positive pressures on prices, which again keeps a lot of people in the renter pool because it makes buying that home even more expensive. It keeps people in the renter pool for longer. So gotcha. I'm not seeing an improvement in housing affordability in San Diego, which is unfortunate for the renter and home buyer, but for apartment investors, it really bodes pretty well. Wow, that is interesting. So let's go. I know this is another area that we'll delve into real quick, but I think it's a pretty obvious one with what's going on in the markets right now and what's going on with manufacturing overseas and trying to bring stuff back to the U.S. But jump into this one, the industrial side. Yeah, we'll keep this one real short. I think it's probably the most obvious one of all. Your e-commerce giants who can remain nameless, but we know who they all are just buying up and leasing up more warehouse space than anybody can even imagine. And if my Amazon cart is anything like yours, they're going to be doing very well. Right. So I see that happening, and we're definitely going to see some more. Everybody's calling it nearshoring. We were seeing it before with the trade war with China. People moving companies moving their warehousing and manufacturing operations close outside of China and closer to the United States. Mexico will be a big benefactor of that. We're seeing very strong industrial activity in Otay Mesa right now because of its proximity to the border, both a lot on the distribution side, but manufacturing as well. And so there's a very strong case for industrial bull and put that on top of, that's really the income side like we talked about. And the interest rate environment is the same. I mean, it's only going to improve. And cap rates will follow.
Wow.
So
that's awesome.
A lot of industrial stuff's solid gold right now.
That's good. That is good to know. And that makes sense. That makes perfect sense. I know I'm supposed to be doing a trip to Shasta. I'm climbing Shasta at the end of the month. Awesome. So yeah, it'll be interesting. I haven't bought all my stuff yet. I was planning on buying it from REI. I wanted to go there, actually look at the stuff, get it. But it is what it is. So now I'm basically have a really large cart filled with in my Amazon account with all this stuff I need for the trip. So,
which is a great segue into retail, I think, if we can slide into that.
For sure.
I think we're starting to see some, on the big box stuff is probably where most people would make the bear case for retail, but we're seeing Amazon, rumors of them talking about JCPenney acquisitions and theater acquisitions and some of the businesses that are in that big box retail space. And so I don't know what their plans are for all that, but that's probably the weakest area of retail, and it's seeing some interest. So again, maybe it's eating reinvented, but really what I want to spend the most time focusing on here is what most of San Diego is and what most private investors own in terms of the retail space is your strip centers, which in San Diego is almost exclusively, restaurants and salons and, service oriented type businesses. Gyms would be included in that. And I think there's a strong, bull case to be made for that as well.
Cool. How does that work? Like, what do you think for the strip malls? What do you think is going to be bringing those back to life? What do you think can bring those back to life over the next several months?
So we'll talk about a couple of things. So first, let's go back to their consumers, right? Those are those same tenants in the multifamily space we were talking about that are making more money and spending less over the last few months. And as those people start to go back out, as we start to reopen, the money that they spend is generally not just kept in a bank account. These aren't savings. These generally get injected right back into the economy. And every time they go out and they get their hair cut, their stylist or their barber takes that money, puts that in their pocket. They go to a restaurant that they spend money. They tip the waitress. The waitress goes out and goes back to that barber, hairstylist. And so you get this real compounding effect when you inject money into the lowest ends of the economy. So every dollar that's spent gets recycled 2, 3, 4, 5, 6 times over, which creates a real rapid acceleration of the economy. So this isn't top-down economics. This is bottom-up economics. And I think that $3 trillion, a big piece of that is coming down at the bottom. And again, that's not even counting the state unemployment funds that go in, which is probably a few trillion more, but I don't have any data to
Gotcha.
calculate. So I think so that's going to be one part on the consumer side where I think that's going to rebound quicker, and that acceleration and that recycling of that capital is a unknown, but is likely to be more robust than I think a lot of people think. The second thing is, humans are very social and our memories are very short. So, we've all been yearning to go out to restaurants, maybe get your beard cut. But going back out to those things, and I think we'll, barring a major second wave, those are gonna be the first places we're gonna want to go back out to. I think gyms are going to see that. And again, they got to reinvent their business model a little bit, and they're going to be a lot more social. They're going to be more like social clubs than just having some equipment laying out on the floor like they were before. So they're going to be a lot more active on social media, and there's going to be, new aspects of their business, but that comes with new revenue streams, and the creative are going to survive. I think that's particularly, a little bit easier to do probably on the smaller gym formats where things are a little bit more personal. Your CrossFit gyms where everybody that shows up at your workout and stuff like that. But it's going to, and they'll integrate some workout at home programs, some online offerings, some outside workouts, which is great in San Diego. I mean, we've got perfect weather here, like 360 days a year. So, gyms, I think in San Diego are in a pretty good spot compared to some, say in, the Northeast.
I got to tell you something about that, because this is interesting. I've talked to a couple of gyms. I've actually talked to a flamenco artist. They've all gone virtual. It's crazy. And they're actually doing a lot of business. Like the flamenco studio that I spoke with, she's doing more business now than she ever did before because she went virtual.
And I think she's going to see some of those people that'll come back into their studios, and they're still going to want that. But
Yeah.
now, in addition to that, they're getting the online business that they never had before.
Definitely.
And so I'm going to mention this a little bit in the office piece, but I think this technology thing has accelerated. We probably saw 5 years of technological application in people's businesses happen in 90 days. I mean, that's tremendous. And those investments made, I mean, you've seen it in Zoom stock if you've been watching that. I think that's what we're on here. And I think that's going to be something that a lot of businesses are going to take advantage of. And it's just another revenue stream. So their expenses can stay the same and their revenue potential goes up.
Definitely. I did a deposition via Zoom last week. So I actually, I was defending one of my clients, and they did the whole deposition online. I had my client on a tablet, and he was sitting here next to me. So he basically, the whole entire time that he did the deposition, he could get on there and he could mark on exhibits and do all the things. And I was amazed. I didn't think it was going to work, but
yeah, I mean, before this, I think, it was not uncommon, but certainly not very common to see people with 2 or 3 gym memberships, that had maybe different focuses or features. I certainly know a few of those people. I think you're going to see a lot more of that, where maybe your old gym membership was $40 or $50 a month. And maybe you still have that, but you also might have a $10 a month virtual membership for that flamenco class or that, yoga place or something like that, where it almost is more of a Netflix type model. And you create a real social interaction that, again, that price point comes down. The investment that the business owner has to make is a video camera or a laptop. And, they post them every day or every week or a couple times a day. And that's a huge revenue stream that was untapped, and maybe they didn't realize that the consumer market was there for it. And now it is.
It used to blow me away. I actually had memberships at Core Power Yoga, at Orange Theory. I had a boxing gym I was a member of, in 24 Hour Fitness. And those 3 places that I went to, the 3 not including 24 Hour Fitness, I bought all my classes individually. I bought them as a package, like 20 classes at a time, and just use them whenever I want. And a lot of those gyms, I think they're getting smarter about it, but they're starting to do more stuff like that. And I think what you're saying about doing like a reduced cost for virtual classes is really smart.
Yeah, so I think you're going to see that. Even Planet Fitness, they're a fairly large operator. They announced last week that they're planning a massive expansion, which I got no news coverage, but I think it's indicative of where they think that's going. You get some bigger formats that might have a harder time with it, but I think your small mom and pop fitness operators have a massive opportunity in front of them if they can harness the technology and are smart with social media and can convince people to be take on that second or third membership. I mean, we're already doing it with our TVs at home. You might have Disney Plus and Netflix and Hulu and all these different streaming services, and you got 2 or 3 of them that replaced the one cable bill, right? But there's a lot of people that are spending more on those streaming services than they were on a cable bill before, or still have a cable bill and have bought those on top of that. And I think you're going to start to see that with gyms. It's and I don't think that, again, that's not it's a little bit contrarian right now.
Yeah. I mean, if you got a tablet, you can go out in the park and go along with the workout. Like, you don't have to be at the gym to do it.
Exactly. And be out in San Diego weather, which is tough to beat.
Yeah. Run over to the park and do it. I mean, it's not going to work in Wisconsin in the winter, but
Yeah. They have basements though. They have basements.
Oh, that's true. Yeah. They got way more basements, huh?
Yeah.
That's very true.
But I think restaurants would be the last one to touch on. That I think.
Did you go into office?
Let me make 2 sentences here on restaurants, and we'll hit office, because restaurants are kind of in the retail space. Where what I was really watching was the delivery apps. And you saw Shopify and all those other ones are getting huge things for people getting groceries, which makes sense. And maybe that dies off once people go back to the grocery store. But restaurants, it was largely flat, and there was a big movement to go, the hashtag delete the delivery app movement, where restaurants were encouraging people to order direct. Right. Restaurants can make a lot more money by doing deliveries than they can with dine-in customers. You're not as reliant on turnovers. You can do way more volume out of the same kitchen. You have less labor costs. You have less dishes. You have less all this kind of stuff. The delivery, there is an expense there, and I think there's going to be some compression on the pricing from delivery services. But I've got friends in Shanghai and business owners in Shanghai. Restaurants are full again. They're full inside the restaurant spaces, and their delivery business is still through the roof. And so again, this is just another revenue stream. And I think with a lot of folks ordering direct from the restaurant, they can kind of cut out a lot of the delivery services, which are, a little bit more expensive here than they are in China. But I think if we see some compression in that space, it's going to make it very competitive. And I mean, there's a lot of people right now that might not be willing to go back out to a restaurant today, but they still don't want to cook, So having that stuff delivered in and take out is another revenue stream. And I'm seeing some people do, they're calling them ghost kitchens. Have you heard of this?
No.
So what a ghost kitchen is a ghost restaurant is.
I don't know if I'd want to eat there. Let me just caveat that first.
It's
I don't like ghosts. I'm afraid of ghosts.
It's an industry term, so so I wouldn't worry too much about it. But what we're seeing is so let's say you owned a Mexican bread restaurant or an Italian restaurant. What you can do, and you can't have an Italian cuisine next to Mexican cuisine in a restaurant. It's kind of weird, right? If you have, sort of cuisines that don't mesh up. But online, you can open a second restaurant that doesn't exist in a physical space, but you can use that same kitchen. So the front of the house, in a strip center, they're still serving, the great burritos and tacos you do them for. But in the back of the house, they're making pasta and got that going out on another second restaurant that's online only and delivery only.
Oh my God. So you could diversify your kitchen, reduce your space for the actual dine-in space, and then
Exactly.
wow.
And have a whole second business that didn't exist before that now is delivery only. And I think, delivery apps were largely flat through through this thing, despite the pressure to delete the delivery app to help support local restaurants. But those are the first places people are going back out to. Those are the first places that I think all of us are excited to support our favorite, local restaurants. And I think that will continue. Again, we're social creatures. We're going to want to go back out. And I think our demand to have, food made for us is not going away anytime soon.
Yeah.
If anything, it's going to increase. So again, do they have to get more creative? Absolutely. But there's a big case that those restaurants are going to be more profitable, and as a result, be able to pay the same or more rent to these landlords, and again, be in a good position.
You know what we've been doing? This is interesting you bring this up, because I have friends that are in Arizona, and we have friends that are in the Netherlands, and we've been doing these breakfasts, these Sunday morning breakfasts, where it's actually dinner for the people in the Netherlands.
Yes.
Yeah. So it's a breakfast, but we do a breakfast Zoom meeting where we basically do via Zoom. We all meet for breakfast. We sit down, we all have a conversation. It's pretty cool. I've been pretty impressed with it. I thought it was going to be really wonky, but it's been fun. It's been fun. But what would be cool is to have an actual thing where you have, this would probably be better with chain restaurants, but let's say Applebee's, you and 5 other friends from around the nation all say, hey, let's do dinner together. And everybody says, let's go eat at Applebee's. And instead of going to Applebee's, you just order Applebee's. It gets delivered to your houses at the same time. And then everybody eats via Zoom and has a little dinner.
Yeah, I think we're going to see stuff like that, come to fruition. But the restaurants, I think, got the brunt of this early on. But I think there's a really strong case to be made that their recovery will be robust, and that after this, again, with people being happier. I mean, my parents, for example, had never had delivery apps before, and now have 2 or 3 of them on their phones and are now comfortable ordering it. So again, we've seen this technology that would have taken years to be fully integrated get accelerated into 90 days. And I think this creates, for the right tenants, a real business opportunity, and that's going to translate into rents, and that translates into values.
That's funny, because you think about the baby boomers and the people that have a lot of trouble with technology. Technology is not that hard to do. It's just a matter of being forced to use it. Yeah, it's interesting.
Which is what we're going to talk about for office. I think next, if you want to go there.
So let's do it. Here's the office. So here's the email that you put out for the office polls. Jump into it.
Yeah, and I have some more data that I've seen since then. So so everybody listening here will get a newer version than this email. But as a lot of people knew, previous to the pandemic here, people having private offices and stuff was kind of the thing of the past. And depending on on the industry. The average space per employee had dropped, very significantly, 40% or more. That was particularly true in the legal field there, Eric, where even attorneys were giving up their famed huge offices with the couches and everything. But so I think you're going to see that grow. I mean, it's hard to put employees all close together and still have 6 feet of separation. I'm already seeing a lot of interior designers, a lot of large tenants sort of spacing their workers out more. We're seeing large Fortune 500 companies. There's, it's the guys that are getting the press are the ones that are saying we're going to keep our people working from home. But I would say there's just as many. They're going to say we're going to keep our footprint or maybe even grow it a bit to allow people to space out. And we might allow people to work from home more, but we still need these collaborative spaces. We still need people to see each other. Even here among my small team, it's incredible how much more fidelity you have when you're in person. And again, we're social animals, just like we were talking about in the retail sector. Being next to each other, there's just so much more collaboration. It's the same reason that we saw co-working explode. That desire to work together, even for independent and small firms, they were all flocking to co-working because there was this energy and this collaboration. That was true. That's real. That energy was there. Are we gonna have? Absolutely. But office also, I think, has a pretty easy way to do that. Most office buildings already had 5-day-a-week janitorial, so maybe they got to change some of their cleaning services. Maybe they got to increase that a little bit. We're seeing a lot of office landlords install, hospital-grade air filtration equipment that'll really make people feel comfortable in coming back to work. And I think will increase worker productivity, even on non-corona, just from regular flu seasons and colds and stuff like that. And maybe we say some companies go, yeah, work from home Tuesday, Thursday, come to the office Monday, Wednesday, Friday, and stuff like that. But you still need the space for those employees to come in. And so I'm not seeing the crazy, huge drop in office demand that I think a lot of people are forecasting. That just hasn't been what I think most employers that I've talked to are looking for. They're going to reconfigure their space, no doubt.
Because that 40% reduction in space that's happened over the past 20 years, that's going to need to be expanded again.
It's sort of the age-old thing. The pendulum moved too far. I would say the people were already saying that this was too close. We were too close together. People jammed in 4-foot desks. Some companies are starting to look more like call centers than they were, professional companies.
Yeah.
People want their space, and that's going to come back. But I mean, even a little bit of growth in that can totally absorb any drop. And I think you're going to see maybe some of those spaces become bigger conference rooms and bigger collaborative space where when people do come into the office, they have a place to collaborate and work better in teams. But that's not going away. That's not going away.
That's interesting. That's an interesting perspective.
So
that's a little counterintuitive with what's been going on, but yeah. I think you're onto something. I mean, that makes sense, especially considering how much more space you need. A lot of the space that people already have, all they need to do is basically retool it, refit it for their employees.
Yeah. I mean, the furniture vendors and the interior designers and space planners that I've worked with have all changed their designs like on a dime. And people need more space than they did to fit the same number of employees. And again, even if that employee is only coming in 3 days a week now, the idea of hot desking people is what we used to call it, where 2 employees might share space.
Gotcha.
Share one desk. Yeah. That's not going to be okay in an environment where everybody's worried about germs and disease transmission. So there might, some companies are going to downsize, no doubt, and go more remote. A lot of companies are going to expand, and some companies are just going to stay the same and just retool their space, with different furniture and different, protection methods. But
interesting.
I think there's a strong case to be made for stability in the office segment.
That's pretty cool. That is very cool.
The last thing on the office side is that we're going to see some drops in supply. There was a lot of industrial buildings that were converted to office in the 80s and 90s and early 2000s when office was in more demand than industrial. A lot of that's being reduced and turned back into industrial. Biotech is an industry we haven't talked about at all. Office buildings are uniquely suited to be adapted to biotech labs, for which there's a massive demand in San Diego. Yeah. So even if there is some demand softness, I think from your traditional office user, there's going to be some supply side constriction in that it's going to be buildings are going to be repurposed from office to biotech or from office to back to warehouse. That a lot of other markets, outside of San Diego may not have the advantage of.
And it's not hard to do switch over office space to build clean rooms. I mean, build clean rooms for the biotech and also for
it's expensive, but it's still
digital.
cheaper than building a new building.
Yeah, right. Yeah, for sure. Yeah. No, that's an interesting point. That's a really interesting point.
So, and cool. We just thought Qualcomm's a perfect example. They were vacating a building around 100,000 square feet. They sent in their notice to vacate to their landlord in, I think, third quarter last year. And they just flipped on a dime, and now they re-signed a lease in the building they were supposed to be leaving.
Oh, really?
and took that space back off the market. So in a post-COVID environment. Apple signed 4 leases here, 4 full building leases in San Diego late last year. So, they're still going to be operating those. And again, most office leases are 3 to 5 years. So you're not going to see a big dumping of space coming on the market because lease lengths are staggered and typically longer.
Gotcha.
Companies are going to retool that space, and I think it'll be absorbed.
Wow, that's crazy. Well, let me do this. I'm going to put this up real quick. You have an amazing newsletter, and I got to tell you, I really appreciated it when I got it because this information that you provided was amazing. So people, if they want to get on your newsletter, they just reach out to you, and you can give them.
Reach out to me, and you can. There's a form on our website where you can subscribe for it, which is caacre.com. Or feel free to email us. Also, in this COVID environment, we are doing free building reviews. So I can, we can take a look at some of your leases and your loan and try to help people with giving them some practical advice, because this is a dynamic market where the assumptions they made 6 months ago might not hold true anymore. And it's really an important time to kind of plan for the future of their portfolio.
Well, it sounds like you got your finger on the pulse, that's for sure. Well, Here's the information. If anybody needs to get in touch with Brian or anybody wants to be connected and get his newsletter, which I would highly recommend getting this. It's really good. You can email him, or actually you can reach out to them at www.caacre.com. It's there on the screen. It's Commercial Asset Advisors again. Brian Jenkins is the principal, and I want to thank you for being on the show. I really appreciate you being here today, and I look forward to going over the bear argument in the next video. Yeah,
well, looking forward to it.
And I can't wait till the market opens back up and retail opens back up. I know I need some manscaping. So I'm going to work on that and get the beard trimmed up. And then also, I would love to bring you back on the show too, to talk about 1031 exchanges and maybe do it with a 1031 exchange company.
Yeah, so absolutely. We've done a lot of that business. There's lots of horror stories out there about 1031s, but it's not the fault of the tax code. These are, it's important to have the setup right, and we can talk about some strategies for that.
Yeah, it's a ticking time bomb if you don't do 1031s right. You find out 2 years later that, oh wow, I got to pay taxes on all that.
Yeah, there's real estate is a very tax preferred investment class between depreciation and 1031 exchanges. Something that can't be said for stocks and bonds and some of that other stuff. So it's important to take advantage of that. It's one of the best benefits of being in this investment class.
Yeah, and this is the thing I always tell people whenever they ask me what's the benefit of 1031. When you do a 1031, it's the benefits to your family when you pass away. Because if you know anything about estate planning or the tax code for when you die, there's a thing called a step up in basis.
Exactly.
And it's the most beautiful thing in the world. I mean, there's nothing better than that. So,
it really is.
Yeah. I would love my viewers to understand that, because I have a lot of viewers that are attorneys, a lot of viewers that are professionals, real estate agents. I think it would really be helpful.
There's so many misconceptions because everybody's heard horror stories about how 1031s are done. Having done a lot of them, and all of them very successfully, there's massive benefits, but you do have to set them up right. You do have to be smart. You have to think ahead and have a strategy before you just start that time bomb.
Yeah, and you can do it in a fractional ownership too. You don't have to actually take the building on and do it yourself. I mean, you can at some point in time just transfer it over to a REIT or whatever they're called.
There's DSTs that are an advantage. Those are great for boots. We can get into what a boot is. It's not the ones you're gonna be wearing on your hike. Here in a while, but there's monetized installment sales. There's shareable remainder trusts. There's 5 or 6 different categories of ways you guys can avoid taxes when you do sell an asset, and so we can help with all that.
Cool. Well, let's do it. Let's set up a date we'll do the bear one next. Hopefully get that out in the next month or so, month and a half, and then we'll try to get the 1031 exchange set up. We'll find a 1031 company to do it with you and get it set up.
Yeah, love to.
Cool. Awesome,
Eric,
Brian. Thank you so much.
Appreciate the opportunity to speak to your followers.
Absolutely. Brian, thank you so much for being on the show, and I will catch up with you on the next one.
Okay. Thanks, Eric.